Hey Dave, how you doing today?
I'm doing great, Nick. How are you?
Not too shabby, all things considered. We got some beautiful colors going on
Yeah,
outside and
we
cooler temperatures coming around the corner. It's been unseasonably warm though.
woke up to rain this morning, and I've never been so glad to see some rain
Is
because
it?
it's been like way too long. We have
Yeah,
a
feels.
drought of biblical proportions going on up here in northern
Yeah,
Michigan.
for sure. So it speaking of fall weather and color
Right.
changes, it's that
Nice segue.
time of year to talk about the markets, and we just
Yeah.
wrapped up the third quarter, and we're 23-ish days into the fourth quarter.
Right.
So we wanted to take some time and review what happened last quarter and kind of give a little bit of an outlook of what's potentially next.
Yeah, lots going on, and hard to believe we are already three-quarters of the way plus through the year. But
Mm-hmm.
here we are, right? Time waits for no man or person, I should say.
Very true.
So, as our as we normally do with these, we've got our glass half full and glass half empty chart from our friends at East Bay, which
Mm-hmm.
we really like the way they frame this up because. Um, you know, macroeconomics is very much an art, not a science. And there's a great piece today in the Wall Street Journal that I was going to point out to you about how wrong all the economic models have been over the last 4 years of how, how inflation, unemployment, and government spending should
Right.
work together according to, you know, Keynesian models and different
Yeah.
approaches to macroeconomics. And it fits well with this idea that, you know, macroeconomics is always interesting in that we develop these neat little models, but it's not physics, right?
You're right. Well, and we
So,
develop models based on past behaviors and patterns that
right.
we find, and
Yeah.
turns out that they don't predict the future very well.
Right. Right. Yeah. Yeah. Unemployment is not like quarks and protons. So, all right. Anyway, we've belabored that many times over the last few months. On the glass half full side, what's going on?
Inflation, inflation, inflation. Down
Yeah.
to 2.4% in September, continuing
Yeah.
that trend of downward the slowing pace
Right.
of price increases. Not necessarily prices going down, but the slowing pace, which is important and kind of the number one target of the Fed.
Yes.
And so that kind of, the benefit there is it gives them the ability now to kind of pivot and start looking at labor markets and where things are there
Right.
and decreasing interest rates, which we saw last month.
Right, right. And our second bullet point on the glass half full side of the ledger is they've done all of those rate increases and brought inflation down without really breaking the economy. And
Yeah.
so Mario and Eric pulled out four of their favorite cyclical indicators that normally, like if there's going to be a recession, at least one of these would be flashing red signals right now. And
Yep.
I won't go into too much detail, but residential investment as a percent of GDP, light vehicle sales, business fixed investment as a percent of GDP, total business inventory sales ratio, those four things, one of them is usually showing like scary signs before there's a recession. Not necessarily all of them, it's not perfect, but there is nothing there indicating a major economic slowdown right now.
Dare we say it, Dave? Is this the proverbial exclusive unicorn of a soft landing?
Well, I don't want to, never say never, and things change fast in this world. But I think at this point we might be able to, like, I wouldn't want to say, well, there's no recession coming, right? Because like
Right.
there was no recession coming in February of 2020 either, But I
Right.
think
Yeah.
that's kind of the point is like from a macroeconomic standpoint, model standpoint, it doesn't seem like what the Fed has done will cause a recession. They were
Right.
able to get inflation under control, and there's not a recession imminent. That doesn't mean we can't have some external shock that causes one, right?
Right.
That can always happen. And it also doesn't mean that like 6 months from now we're not going to be going, oh gosh, there it was.
Right. Yeah.
Things can change fast, but hey, you know, I it's played out way better than I think anyone that we listen to or talk to expected.
Yeah. Absolutely.
So, you know, bully for the Fed.
Yeah. Be grateful for where we're at this
Yeah,
point, right?
yeah, yeah. So,
uh,
so the third bullet point on the glass half full side of the ledger is another like major recession indicator is looking at the yield curve,
mhm.
and so that's looking at what 2-year Treasury bonds are paying for yield versus 10-year Treasury bonds,
Yep.
and typically when those are so a normal yield curve is you're going to get paid more for locking your money up for 10 years compared to 2 years, right? We would expect a higher interest rate on 10-year bonds. And
Yep.
for like 26 months going into this last quarter, that was inverted, where 2-year bonds were paying more than 10-year bonds. And that's an indicator that the markets are expecting a recession.
Right. Hmm.
So it's always been a harbinger of economic gloom, right? But now we've seen that normalize again as the Fed lowered rates, short term bonds came down, but 10-year bonds pretty much stayed where they were. And that's kind of put us back in a normal yield curve situation. And that's a positive thing, too.
Yeah. And a good development in terms of that relationship. And, it's one of those where it seems like everybody points to that yield curve as like the end all be all, like,
Right.
and this will mean recession. And it's just another case in point of that's not always the case,
Right,
right?
right. Well, it's correlation and causation, right? The
Right. Right.
inverted yield curve doesn't cause a recession, but it tends to
Hmm.
occur at the same time as a recession. It doesn't mean like one necessarily follows the other, but
Right.
yeah, but I'll to be quite honest, when we saw that inverted yield curve, in boy, we're going back to like 2022 at this point. I was,
Hmm.
that got my attention real fast,
Yeah.
and it's kind of a relief and in a way a little bit validating because we talk about how you can't really predict these things, and like so if you had tried to trade based on that, you would have missed out on one heck of a stock market rally, right?
Right. Well, and interestingly enough, 26 months was the number of months that it was inverted, right?
Yes. Yeah.
So that's a
Yeah.
long time to be like, all
Yeah.
right, well,
Yeah.
I'm going to get out
Yeah.
now and wait until
Well,
it's reinverted the right way, right?
right, right. Well, and like 18 months into that, I was thinking, well, if it stays inverted long enough, essentially, eventually we'll have a recession, and then everybody will say, well, gee, you know,
Right.
but now we've got it back to normal. So okay, so I
Yeah.
guess it'll always be that back to that, the models don't work, the models aren't predictive, aren't. It's not that they don't work; it's that they're not predictive,
Right.
um, is a little bit validating in the story we're always telling customers and clients that we can't just because there's these things that look a little bit scary doesn't mean we go drop our stock allocation by 50% or anything based on
Right.
that.
Yeah. Timing the market is a fool's errand, and it's never been more apparent than what we've
Right,
seen in the last
right,
26 months,
right,
right?
right. Okay, so now we've got to pivot to the other side of the equation, right? So we've talked
Yeah.
about the kind of the good points and where we sit right now. What are we worried about?
What aren't we worried about these days? Uh,
Yeah, yeah. We're gonna get to that as one of the bullet points.
Fed's concern shifting from inflation now with those numbers coming down to the labor market. We saw unemployment
Yeah,
rise slightly above 4.2% in August. And
yeah.
so it had been under 4% for a long time. And now
Hmm.
we're getting to that point where it's going the other direction.
Yeah,
And so the Fed obviously wants to shift their focus from inflation, which they won't ever come out and tell you that they beat it,
Right.
but they're feeling pretty good about it. Otherwise, they wouldn't have started lowering interest rates, right?
Yeah, and it'll be interesting to see because that was a big rate cut in September, half a
Mm-hmm.
all at once, as the opening salvo of their change in policy, and it'll be interesting to see how that does change the unemployment trajectory here over the next few months. Um, Again, we've seen the weakness of the models, but the models would tell us that then we should see that be enough, that should be enough stimulus to hopefully flatten out the trajectory of unemployment. Not that unemployment's bad right now, it was more the direction.
Yeah. Yeah.
So,
Yep. The direction and the pace of which that was moving in the opposite direction, right? Like,
yeah.
I think that was big, a little bit concerning for them and where they were at. And so, but, as they made that rate cut and we actually got some revised numbers, which, it's hard getting these numbers and they're not always perfect. And, we live in this
Right.
generation of like, I want everything right now in this exact moment.
Yes.
Mr. Bezos will deliver it to me in under an hour
Yes.
now. If
Yes.
I ask him nicely, like that's just not the way these numbers work. So
Right.
there has been
Right.
some revisions to that. But yeah, it's just one of those things that, they're kind of focusing more on now. So
Yeah.
the second bullet point we have here is something that's kind of always somewhere on this list, and that is geopolitics, which we've talked about quite a bit. And
Hmm.
then I don't know if you know, Dave, but there's a, U.S.
And
election coming up, and
I,
it's kind of fraying some nerves out there as far as
I've
investors
been
go.
I've been actively trying to forget, but it seems like
Until you
I'm
open
just
your
not going to be
mailbox
able
every
to
day.
escape. You can't even watch a college football game
Yeah, right.
without being bombarded. Anyway, so
Uh,
obviously everybody's in tune to these two things more acutely than ever right now. We've got and the one kind of accentuates the other. So we've got things pretty hot in the Middle East right now, which from a market standpoint affects oil, affects a lot of the things that are inputs to the U.S. economy. Not just obviously, we worry about instability and the humanitarian impact on markets as well. So we've got some concerns there. Those are always there. We've been dealing with the
mhm.
Russia Ukraine war for a couple of years now. Um,
Yep.
the election, I think, accentuates that because you've got both sides pointing fingers at the other, saying they don't know how to handle this. And
Right.
if so, both sides are basically telling us if one or the other candidate wins, things are going to just get worse, as though the U.S. can somehow magically fix a problem that's been going on for at least 3,000 years. But
Yeah.
that's kind of beside the point in terms of how we feel about it right now. Um,
Yeah.
we've
So
spent a lot of time. Oh, go ahead. Sorry.
no, I was just going to say, what I like to think about and focus on is, we're not investing for the next president and who and what happens in the next 4 years, right? Most
Right.
of us are investing for a much longer time frame than that. And I love this slide that we'll have to put in the show notes from Mario and Eric about
Yeah.
staying invested regardless of your political views. So I'll try to explain it, but definitely come check out the show notes. And that is, if you only invested during a Democratic administration, if you only invested during a Republican administration, this is going back to the 1900s and investing 10,000, or if you were fully invested the whole time, your difference is, you know, Democratic, Republican, pretty even about, looks like maybe
Yeah.
100, 200,000 or so. And if you just left it in the full time, you're looking at having about $10 million as of,
Yeah.
a couple of months
Yeah.
ago. So, I know which one of these lines I would prefer, But
Yeah, right, right. And it just goes to show, and we've shown this and we've talked about it, and we've got a whole bunch of different slides that we've posted on our blog posts in different places that basically show the market really doesn't care who the president is or what their party
yep,
affiliation is. And we've seen the economy absorb good presidents, bad presidents, business friendly presidents, anti business presidents. What really matters is the cycle of the US economy, which
hmm
straddles administrations. And we want to make king figures out of these folks as though they can magically change the trajectory of the economy one way or another, and it just
right,
isn't true.
yeah.
So,
Yep. And so,
um,
I just go back to that. Like, if you're investing and you need the money in the next 4 years, you probably shouldn't be invested anyways. And if you're a long term
right.
investor, then you probably shouldn't let it worry you.
Right, right. Well, and so here we are a couple weeks out from the election, and the polls are basically a dead heat. And
hmm
listening to one smart guy talk about the markets I was listening to the Animal Spirits podcast the other day, and their point I
Nice.
kind of made me chuckle because I hadn't really thought about it this way. If the market was really concerned about how either of these candidates' policies were going to play out in terms of the economy, we'd already be seeing chaos, right?
Yeah.
Chaos in the market. The market tries to
Right.
anticipate what's going to happen, and when you've got a dead heat, if the market really cared one way or the other, we'd be seeing stocks dropping in
Right.
anticipation of the fact that one or the other is going to tilt the economy poorly because it's basically a dead heat in the polls right now.
Right.
So
Well, and
anyway.
and I don't want to like be laissez-faire about the whole thing because there are some important issues, and I don't want to
Hmm. No,
underpin
yeah,
them. But what I will
yeah.
say is, it's not about investments and it's not about the
No,
economy, right?
no. We've said it. We've said it probably 10 times on this podcast over the course of the last 12 months. Vote with your ballot. Please vote with your
Right.
ballot because that's the biggest problem with democracy in America is not enough people vote. And
Right.
and don't vote with your portfolio.
Yeah. Yep.
So, all right, we've
All
got one
right. Moving
more
on.
on here. Yeah. Phew. I feel like all the
We're
air
not
got
we're not
sucked
making it
out of
any
the room.
easier either, right?
Right, right.
Oh, don't worry. This
So,
next one will help, right?
you know, I think every quarter that we've been doing this for a couple of years now, we've had China on the glass half empty side in one form or another.
Right.
So
Mm-hmm.
China, we saw China, start to really struggle with their economic numbers over the last few months, and so in September, their government basically shot the money cannon and said we are just going to stimulate everything to create growth again.
Right.
And the emerging markets index reflects that. We saw
Mm-hmm.
their Chinese stocks jump, and of course that China's while they're still considered a developing market from a stocks equation, they are a huge producer of things we consume. So,
Right.
and it's a very large chunk of the world's population. So, um, how the Chinese economy goes in a way, so goes the world.
Right.
And
Yeah.
so what we need to see and so I guess what this bullet point is getting at, and I'll just read it: will China follow through on the stimulus packages that they've proposed, and will they be enough to boost consumer confidence and bolster their property market? And I guess there's always been this disconnect between what the Chinese government tells the rest of the world and what they necessarily do internally. So,
Right.
now we need to see how that plays out. And, part of me, like back this summer when we started seeing real weakness, I guess it was, I forget the exact timing, but part of me was like, oh gosh, if that's what they're telling us, it must really be, it must really be bad.
Yeah.
so,
Right.
so, you know, uh, it's interesting how that, uh, affects us and how that'll play out. So,
Yeah, it certainly bears watching in terms of how that impacts things.
Hmm.
I can't think in the years that I've been doing this, like where they had a slowdown of this nature that they didn't weren't able to come out of the other side very quickly, and so it's kind of going to
Yeah.
be a test for them and their model and kind of how they're doing things. So, and like you said, that that we're more so than ever before, the world is connected, right? And so every
Right.
piece of this, like if something goes wrong with China, it does impact a lot of things around the world now, much more than ever before. So
Right. Right.
certainly something that
And and we talk a little tongue in cheek about how every quarter there's something on here about China, every quarter there's something on here about geopolitics. It just drives home the
mhm,
point that if you are really uncomfortable, there's never going to be some time when these concerns go away.
right.
They're always going to be there. That's what makes markets. That's what makes the risk that makes the stock market pay off for those who stick with it.
Yeah.
So,
Right.
um,
As we like to say, if it was easy and it went straight up, everybody would do it.
right, right, right.
Everybody just be a
And
100% stock portfolio.
yeah, yeah, and as our behavioral finance experts like Crosby and Morgan Housel would tell you, it's not that like investing itself isn't the hard part. It's not the technical. Like anybody can go out and buy the S&P 500 index in one trade and
Hmm.
have a diversified portfolio of stocks that will be good, and that's what Warren Buffett tells people to do, right? That's not the hard part.
Right.
The hard part is then tuning out all this other garbage and staying with it. So
Yeah. Yeah.
yeah, anyway.
So I want to touch a little bit, if we could, Dave, on now that we have a rate cut. One of the questions that comes around is, well, what will the market behave like given that there was a rate cut, both on the stock side and the bond
Yeah,
side, right?
yeah,
Like,
yeah.
and we do have some history of this. This isn't the first time we've ever had a Fed rate cut, but it's kind of a mixed bag. It's another good chart that we have that we'll stick in the show notes. But it's kind of a mixed bag between
Hmm.
some really good after effects and some not so good after effects. So what kind of knowledge can you drop about what happens after a rate cut?
So just going from this chart here that Mario and Eric provided for us. They've got one, two, three, four, five, six different cycles on this chart and how the stock market performed
Hmm.
in those cycles after rate cuts. And what you really see, three of them were very, very positive. The stock market was very, very
Yep.
positive. Three of them, one of them was kind of in the middle, and then two of them were negative. And I think my main takeaway is it's not cut and dry. Like you said, it's a real mixed bag. But what you've got to look at is why were we in the cycle we were in, and why was the Fed pivoting to cut rates? And
Right.
if the Fed is pivoting to cut rates because we're in the middle of a financial crisis and there's a whole bunch of bankruptcies like 2007, and
Right.
we're wondering if the entire financial system is going to survive. The rate cuts were happening in a very bad context, and same
Right.
with 2001, right? They're cutting rates
Yep.
desperate to head off the popping of the tech bubble.
Right.
So,
We
to
would
support the
expect
market.
then that
Yeah,
markets would go down
yeah,
from there, right?
yeah, yeah. While 1995 and some of these other situations, the economy wasn't really in bad shape. It was more of a proactive, like we're
Right.
going to adjust policy, and that's hopefully where we are right now, based on the indicators we're seeing.
Yeah, and my
So
takeaway was, like you said, a mixed bag, but also like we don't know, right? We've never been in this exact position in time with this exact economy, with this set of factors going into it.
yeah.
So there's uncertainty there. But like you said, if we were, projecting or thinking about it, we're in a pretty good spot from the economy, and so rate cuts, should we would think that things would continue to go up from here, but there's always the unknown, right?
Yeah, yeah, yeah. Back where we started, like the model, like the model that we're taught is as CFPs in our first portfolio structuring classes is the lower the interest rate, the more valuable stocks are,
Mm-hmm. Mm-hmm.
the lower the interest rate
Right.
environment. And
Yeah.
so, for a number of reasons, one is it makes, for a friendly, business expansion environment. For another, it makes bonds and savings accounts less attractive compared to stocks. Or, there's a bunch of things
Right.
that kind of fold into that. But that, at its essence, all things else being equal, if the only variable is what is the interest rate, the lower the interest rate environment, the higher we would expect stock values. So,
Right.
so
Yeah.
we'll see. Yeah.
Well, and another good reminder, another chart on here is the percentage of years the S&P 500 has the drawdown, right? So 94% of
Yes.
years there's been a drawdown of 5% or worse. So even
Yes.
if the long-term results over the next 2 years are a positive market, that doesn't mean it's going to just
Yeah.
go straight up, right? Like
Right.
anticipate having at least a 5% drop, 64% chance that there's a 10%,
Yeah. Yeah.
40% of the time 15, and 26. So essentially 1 out of 4% of 20% or worse, right?
Yeah.
Like,
Yeah. The one that jumps out to me and that I would point out to people the most is that second bar on this graph.
right,
Basically 2 years out of every three expect your portfolio to drop by 10% at some time during the year. Yet
right, yeah,
stock market's long-term average is positive 10% a year. So,
right.
um, that just
And it doesn't
shows
mean
the
that it's
amount of
going to end at down 10. It just means
right,
that at some point you're going to
right.
experience it, right?
Yeah, yeah. Well, look at back in late July this year. What were we down?
Mm-hmm.
Were we down like 8% on the S&P from its? We had like
I think
highs in
so,
early
yeah, somewhere
July. I
around
should
there.
go back and look
And
at
it was
this
real, it
before
was
I
real
talk
quick. It was
about
like a
it.
week.
Yeah, yeah. When we got some bad economic news about the yen and
Mm-hmm.
out of the Japanese central bank, and all of a sudden it was like all bets are off, and we had a real sharp
Right,
drawdown. And then here we are 2, 3 months later posting brand new historic highs on the S&P 500.
right,
So,
yeah.
if you had tried to trade that dip, you'd have been whipsawed.
Mm-hmm.
Yeah.
Yeah. So another interesting piece of this is also looking at bonds after a Fed rate cut, right? And what
Hmm.
was interesting to me at looking at about some of this is, just because you have a rate cut doesn't mean it necessarily directly translates to something like the 10-year treasury going down by that amount, because it's all about like
Right.
expectations of, rate cut means, they feel pretty good about inflation. And now
Yeah.
that the economy looks strong, it doesn't necessarily mean that the 10-year treasury is going to go down lockstep with what the Fed is doing from a rate
Right.
standpoint.
Which, hate to break it to you, all the folks that have been sitting here waiting for the Fed to cut rates so that they could refinance their mortgage at 4% again. We've
Right.
actually seen mortgage rates go up
Yeah.
slightly because they're tied to the 10-year treasury, which hasn't moved
Hmm.
hardly at all. And,
Right.
I think we mentioned this a couple of weeks ago, but, it's one of those also to those folks, I'd say be careful what you wish for, because if we're seeing a situation where you're able to get the kind of interest rates we were able to get, a few years ago, something dire has broken in the economy,
Right.
and
Yeah.
interest rates are going to be down in that situation to try to stimulate a recovery, not just
Right.
ho hum, inflation's back where we want it, so let's go ahead
Yeah.
and you know be proactive about lowering rates. So
Yep.
yeah.
Sorry to break it to you, but Dave's wishing that we never get back down to 3% interest
I,
rates. I
I
can
I'm
hear
sorry. Yeah, I know that may
it.
not make me popular, but it would be a bad thing overall.
Yeah. Yeah.
So
Exactly.
yeah,
So, we always do these, and I like to kind of wrap it up with, yes, we're talking about what's happening in the short term. We're trying to kind of parse through it. And I do think it's
yeah,
important that you're aware of it so that you know like what to expect and not get like shocked by it, because,
right,
shock to me means your emotions are on high alert and you're more likely to make a bad decision. But
exactly.
just remember, this is a long term, we're
Yeah,
long term investing. We believe in long term. Financial planning isn't a point in time, right? It's a
right.
long term process. And so it's, just keep that in mind as we're talking about this stuff. Yeah, it's good to know, but also don't like go out and make decisions based on some of the stuff that we're, pondering here. So,
Right, right, right. Well, we'll see where we're at here in a couple weeks, and well,
yeah,
a couple months. Sorry,
yeah.
and
We'll be
we'll
back
revisit
in
this in January.
January, right?
Yeah, yeah. See
Right
how this
after
plays
our
out.
infamous prediction show.
Yep. Yeah, right. I was thinking about that the other day. We got to go back and see how badly
Yeah.
we did this year. Which this one may be a doozy,
Yeah. That one might
in a
hurt.
good way. In a good way. In a good way. I always
There's-
it's always better to under promise and over deliver, right?
there you go. I
Set
love it.
expectations low. All right. Well, we'll find
As
out soon.
always, yep. Been a pleasure, Dave.
Thanks,
I
Nick.
appreciate it.
Yeah. Bye.